Hey folks, welcome to this special conversation on Business Redefined, your weekly most comprehensive look at the world of business, finance and economics. The much awaited IPO is happening. Kenya Pipeline, 11.8 billion shares, 65% stake by the government, 106 billion shillings, 9 shillings per share. We want to make sense of this, and we are privileged to have the lead transaction advisor, the man steering this agenda, and that is Dr. Ken Belgrade. Welcome on set.
Thank you, Julians.
Karibu
Pleasure
sana.
to be
Wonderful. Ken, so much conversation about the valuation. I am one of those who have raised the issue. 9 shillings per share, if you look at it from a PE perspective, 22x, price to book perspective, 1.66, EBITDA 8.1x. It sounds a bit steep on my side.
Well, thank you. I think this is a perfect platform to actually talk about the numbers. I couldn't dream of a better platform than speaking to you, Julians,
Honored.
about this particular conversation and valuation. I want to start by saying, coming to the market with a value is a process that is regulated. So numbers do not just drop from the sky. I think we have certified experts that actually speak to the methodology, and then all the way to getting the requisite approvals within the organs of the transaction. And this discussion is reviewed by the Capital Markets Authority of Kenya. So when you look at a process, it is regulated. Let's start from there. Now, as to the methodology, when it comes to valuation, you'll agree with me that typically analysts will be looking at 3 methods, okay? We talk about the asset-based valuation, we talk about the income-based, and then we also talk about the relative valuation. At the end of it all, we have to have a basis for setting the price. And so when you look at that triangulation, it's an exercise that was very robust in looking at, from an income perspective, what does KPC outlook look like, okay? And then obviously from an asset perspective, we've engaged, professionals, land valuers, asset valuers, who have actually gone around this country, and they came back telling us that the fixed asset valuation of KPC is 123 billion. That's on a fixed asset. That's on a fixed asset. Yeah. And we're talking about a company that has no debt, okay? So from that perspective, looking at the fixed asset alone, we'll come back to now the perspective of what does that mean, to arriving at the number that we're talking about. And then, then we have the relative valuation. I want to pause here to say that a lot has been said about the Totals of this world, the Kenjans,
Kenya Power,
the Kenya Power of this world. And I'm happy to say, when it comes to the energy sector, you have your upstream, you have the midstream, and then you have your downstream. So if you look at an operator like KPC, over and again we've said that they're in the business of storage and transportation of fuel. Yeah. Just like you and I would team up to buy a couple of trucks to transport fuel from Mombasa to Kisumu. That will not necessarily, put us in a situation where we're talking about comparables, to utilities in this case. Now, specific to those 3 companies, I want to pause to say, when you look at the business model of KPLC, far from what KPC does, very far from it. They may be under the same parent ministry, but we're talking about different things. And again, we're talking about 10 million customers, regulated tariff, but then again, an extended hand of government, 50.1% shareholding, and then Kenjan being the sole,
off-taker from Kenya Power.
When you look at that, then you look at the metrics at the stock exchange. We're talking about a price to book multiple of 0.23x. Now, let me ask you a question. We've talked about fixed asset valuation of 123 billion for Kenya Pipeline. Are we telling Kenyans that we're going to take these public assets and move it into private hands at 0.23x, at less than 25% of its worth? Is that what we're saying before we even get down to actually the numbers? So this is a highly profitable business, high margin business. That's not the case with KPLC. Now, I don't want to be trapped in this conversation of PE. You're not just comparing. You also have to adjust for 2 things. Very important. The margins and the growth.
And equally, Doc, you must also adjust for the fact that Kenya Pipeline is a heavy capex business. And I wonder to the extent that the EBITDA multiple, which is being considered here, which is 8.1x, actually factors that in.
That's a very good question, Julians. I think I appreciate, just like you have, the capital-intensive nature of this business. But if you look at history, we're talking about, a company that has a mix of legacy and modern assets. The 5 line that we're talking about, from line 2 all the way to line 6, They have been financed by the company, not the exchequer. Now, if you look at line 5, for instance, which is today our main line, the eastern line, from Mombasa to Nairobi, 450 kilometers, that was financed by a loan. And those days, if you look at the books historically, the company in 2015 accessed a $350 million loan, for purposes of financing this particular project, which is line 5. And that loan has since been retired. And that's why we're talking about, a debt-free balance sheet as we speak. But then going forward, if you look at the dividend policy, we're coming from the lows of 30 as per the dividend policy that was prevailing to now, a middle ground of 50. Of course, in the past, we've witnessed 80% payout, but that was more of a treasury circular to all the GOEs, where, they were being compelled to move money back to the consolidated fund. But looking purely at the dividend policy that was there, that was at 30%. We've moved it to 50. And why 50%? Because we're balancing the need for, reinvestment and the need also to pay out investors in terms of dividend. Now, we are talking about company going to the market, being de-risked, raising its profile to be among the top 5 with significant changes in governance structure. What that means is that this company will be able to access financing faster and even cheaper through bond programs, for instance. We've seen Safaricom issue, a 40 billion bond program, EABL, and all that is typically cheaper than the traditional bank financing. So what we're seeing is as part of them coming to the market, there's a third objective I never mentioned, which was, unlocking KPC full potential. We talked about, the non-tax, non-debt revenue as one objective. We talked about deepening the capital market. The third one specifically was unlocking, KPC potential. And one of it is actually allowing the company to fund its modernization and expansion, through the capital market.
But Dr. Ken, allow me to jump in there because whereas you would draw this comparison and say that, well, it is not really an apples for apples comparison, if you look at it now from a dividend per share perspective, you'll see a dissonance here because if you look at the numbers that Kenya Pipeline has put out via the IM, it comes to about 3.9%. Compare that with Kenya Pipeline, compare that with Kengen. When you look at it in that perspective, do you feel that essentially it would translate to the fact that going forward, Kenya Pipeline in terms of earnings will essentially be redistributing a huge chunk of the pie?
There are very good theories about dividend. As you know, when you're an investor in the stock exchange, your return is not solely a function of dividend.
That's true.
Your return is a function of dividend and price appreciation. That's what we call the total return.
Yeah.
So we cannot look at a situation where prices of utilities in this country, whether Kengen or KPLC, have been significantly depressed. And that is explained by the book value multiple of below 0.25. So that is why you see, significantly lower PE multiple and very high dividend yield. But if you were to normalize that, you have a different conversation. When it comes to KPC, much as we're talking about 3.9%, no one has told me about the likelihood of price appreciation as a function of the outlook that we're talking about. Significant excitement going forward, all right? Because when you take this company outside the PFM Act, outside the PPDA, outside SRC, outside, the budget process, going through, various, the parent ministry, the national treasury, and coming back, cabinet memo at times, when they want to roll a project, that bureaucracy will be behind us. We've lined up project. We're talking about, putting up a new line, that is line 7. We're talking about expanding a new line from Eldoret to Malaba. That will go all the way potentially to DRC, which is the largest market in our region. Now, tell me what that will do to the numbers. We've not even touched about the fiber optic business, where as little as 600 million investment is going to give us revenue of around 3 billion going forward. LPG is part of the conversation where we are diversifying, investing significantly in that particular business. The 9 shilling, for us, we had to go through a share split of 1,000, a ratio of 1,000, so that we arrive at 9 shilling to make it affordable to the ordinary Kenyan. With, as little as 900 shilling, because, the minimal application amount is 100 shares. So with 9, that's 900 shilling. With as little as 900 shillings, we're seeing all the Wanjikus and the Otieno, participating, because one of the key objectives of this transaction is not to raise 6 billion to the government.
Yeah.
Far from it. That's one of the 3 core objectives of this transaction. If you look at the policy paper, the sessional paper number 2, 2025, it's very clear that we have 3 objectives. One is, yes, we have to raise non-tax, non-debt revenue for the exchequer. That is clear for development purposes. Sure. Very clear. Number two, we must deepen our capital market. Bring on board as many Kenyan as possible to own this national asset. The key word here, used by His Excellency and the CS Treasury, democratize this ownership. And I can tell you, they've repeated to us severally that it's not just about the 106 billion. Ensure that your most important KPI is to bring not less than 2 million Kenyans to participate in this issue. We want to share this asset with Kenyans.
Not less.
Not less than 2 million retailers must participate. As we speak today, if you look at all the segment, if you look at our local institutional, the demand is significant. We are confident that it will be oversubscribed. If you look at our OMCs, we are confident that it will be oversubscribed. If you look at our regional players, they're telling us, this allocation is very little for our appetite. So we have all indication that it will be oversubscribed. The same applies to foreign, okay? So the only conversation we're having today is we must share this asset with
the retail investors.
And I always say we're not selling KPC. We're selling shares of KPC. And put it differently, we're sharing, that national cake with the ordinary Kenyan.
One of the key pillars of your argument on the valuation has been the fact that this is a balance sheet that has essentially no leverage. And you and I do appreciate that a debt-free balance sheet is not an optimal capital structure typically. You basically have to demonstrate that you have the capacity to actually tap onto debt and service it in good time and also be able to explore other options. Do you feel that for other investors looking at it, that could actually be a downside?
It's an upside. The context of this IPO says it all. First of all, when you're earmarked for privatization, there's a freeze on your capex. Or significant expenditure, you're frozen because management has to be given certain guardrails, for investors' protection. That's actually what happened. That is why you see a company sitting on 16.2 billion cash. Cash is not the most optimal way of using investors' money, but the context, the circumstance can be explained by the law because it was not the company doing to actually sit with that cash. And I always say that if that was distributed as dividend, even the conversation around dividend yield would be significantly enhanced, and return on equity would even be better because then, you take that money out and then your return vis-a-vis equity is higher. So in terms of capital structure, I fully agree with you that will be optimized going forward. It's a discussion that's ongoing. It's been factored into the program. So post, IPO outside the government controlling stake, we'll see, a lot of that going forward on balance sheet and off balance sheet. So I would want to assure investors that it's circumstantial.
Dr. Ken, let me hold you there. And we could go on with the valuation conversation, but let's pause it at that point. In terms of your book building, give us a sense of how robust it was in terms of the process, and also so far, what sort of traction are you seeing?
That's a very good question. In fact,
you wish we started there.
It will take me back slightly. It will take me back slightly to the valuation conversation because you see, as part of that process, we reached out to professional investors where, between the seller telling you, this is where I think my value is, and the market, you always have to be neutral because our job, we're professional. We're market intermediaries and we're regulated. So between the seller and the buyer, we reached out. Again, there was an expectation on this side. So we did something we call market sounding with the top 4 largest fund managers of this country. And we told them, here are the numbers, give us a sense of the valuation. And that was part of the book building because ultimately we want this issue to be participatory, okay? And first is that the consensus metric used to arrive at the valuation was an EV/EBITDA metric. The consensus. So no one was telling us about dividend yield, about price to book, about price to earnings, because they understand the nature of this business. They understand the nature of this business. And we had a range between 7 and 8.8x. I am telling you, there are fund managers in this country willing to pay a price of 8.8x EV/EBITDA multiple
on
this particular issue. Absolutely. It is there. So as part of that exercise, we were well informed as to where we would like to price this issue. Not for what the seller, that is GOK, was looking for, or perhaps even what some people are talking about. Having said that, as you know, and I've said it before, the institutional investors of this country have an opportunity to sit at the table of KPC, to shape the future of that company, all right? To create the efficiencies that this market will require, to pass it over to the ordinary Kenyan, but also to earn dividend. And therefore, when we talk about institutional fund managers, if you look at the MEMAT, there's a board seat that has been allocated to them, and we look forward to them actually going on board, working together with the new KPC board, to be the change they wish to see. And that is a precedent in this. That is a precedent. Never before have you seen a company IPOing its shares actually revise its MEMAT to actually allow institutional investors to have that conversation from the onset, so that when it comes to strategy, when it comes to restructuring the operations, or perhaps funding expansion, that conversation is inclusive of all investors.
If you look at this market historically, it's not common that we see the horizon of the offer running about a month. I think it's Jan 19th to Feb 19th. Help us make sense of that.
Absolutely. As I told you, the single most important KPI, when you ask the minister, what would be your measure of success? He tells you the only measure of success for us is to have as many Kenyan as possible participate in this issue. And therefore, for us, it was important, to lengthen that process, allow Kenyans to make all the arrangement that they need, so that, if it's about perhaps, selling a small asset to put savings across, if it's about, getting into your SACCO and having a discussion about a loan to participate, you have enough time to do that. So for us, even if the offer was fully subscribed today, we must allow Kenyans to participate. Those dates are not changing. We shall be patient. We shall go to Mashinani, explain to them what opportunities they have before them. And then, of course, once convinced, we expect, the 2 million number to be on board.
Dr. Belgrade, when many Kenyans look at our previous experience with IPOs, there is a pervasive view that this market has a challenge with price discovery post-IPO. And it has spoken to the point you've raised around the price-to-book multiples. And many Kenyans who I'm speaking to about this IPO are asking me, 9 shillings post-IPO, how do you see it trending? How do you safeguard it?
Very good question. I've seen some analysts, some investment bank pricing this issue at 10.5 shillings. Others, stating that investors should, exercise caution. We've seen different, spectrum on this. But then I'll tell you this, Julian. I think for us, pricing this was not only to raise the 106 billion, it was more importantly to deepen our capital market and signal that the market is ripe for more IPOs. It's a very important conversation for us. And therefore, when it comes to simulation, we've seen it with Safaricom, where we moved from 5 shillings, we went up, and then it came all the way down.
We've stayed there for years.
And stayed there. But I will tell you this. I think the comfort that we have is, first, if you look at the allocation pool, foreigners, we're talking about 20%. East African 20% and others. And we made it clear that it would be important to prioritize our local and then create also vibrancy on the secondary market. So what we see is, because of the demand and supply, not everyone will be accommodated at the primary level. We see a significant activity happening at the secondary market level. But then that will probably happen at a premium, which means that that's another way of stabilizing the price. But again, for us, we've worked with the management of KPC to ensure that post-IPO, we actually giving positive signal to the market that indeed, outside the bureaucracy of government, it is time to actually take this company forward. So between the demand and supply that we witness in the secondary market, because we cannot satisfy everyone, to be fair, at the primary level. That's a conversation we've all agreed. There will be a significant activity happening at the secondary. So some of them, when they tell us they want to own more than probably allocated, we say, that's a conversation of the secondary market. And for us, it's a good thing, because it allows us to actually stabilize this price and hopefully sustain its upward trajectory.
I've asked this question in the past, you sidestepped it. Let me ask it again. How are the early days looking like in terms of traction?
We are not very worried about early days because, as I said, it's a conversation of understanding the opportunity, right? And outside the retailers, those early days, I can tell you the conversation, the pools are full in every other segment. This is not the buzz. We're speaking from a point of being reached out every other day. I mean, there are investors telling us, can we actually, take 20%? But we're reminding them the sessional paper is very clear about broad-based ownership, and the allocation policy is very clear. Otherwise, what we've seen in terms of demand and supply outside retail, ideally, if the government was going for private placement, I can tell you for a fact, Julians, that we will not be talking about this type of valuation. The premium will be significantly higher, owing to demand and supply. It's economics, price goes up. So really, for us, early days, the conversation on Every other segment but retail is fully subscribed. It's a matter of process, going through, their governance processes to appraise, get their IC approval, and then issue an IBG and proceed. But again, for us, that's not the success that we're looking for. The success we're looking for is getting, the Otieno's and the Wanjikus to participate. And therefore, yes, it's still some work to be done by ourselves. In the coming days, expect, increase, campaigns. We have to be on the ground. Yeah. We've actually, made a strategic decision to go slow on roadshows to institutional and foreign investors and focus exclusively on retailers, because this IPO was done for retailer. If we did not choose, or rather the government did not choose the IPO as a method of privatization, I can tell you for free that not only they would have closed this probably faster, but at a higher valuation. But that was not the intention. That was not the intention. They have repeated to us, our intention is not to maximize on this particular sale of share. Yeah. Our intention is to democratize the ownership of this national asset. Yeah. And they've repeated that, please, for you guys, we want you to deliver on the 2 million retail target. And that's the job that we're doing.
We've been having a conversation with Dr. Kenneth Belgrade from FIDA Investment Bank, the lead transaction advisors spearheading the Kenya Pipeline initial public offer. 65% divestiture, seeking 106 billion shillings. But more than that, he has said there are a number of other priorities, especially focusing on widening the access to retail investors. We shall keep tabs on this transaction to bring you the latest as and when it happens. Stay tuned.